Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about a 24-year-old stock trader who accumulated over $8 million in earnings over a span of just 2 years. So for more videos just like this one on these amazing success stories and how you can replicate this success, don't forget to go and annihilate that like button right now, subscribe if you are new, go ahead and become a member of this channel for as little as 99 cents per month because that's what keeps me here on YouTube. And with all of that being said, I say let's jump right into today's story. We are going to be going over 4 indicators in which this stock trader relied on to inform his buying and selling decisions. And this stock trader is known as Jack Kellogg, who embarked on his stock trading journey immediately after finishing high school back in 2017. Kellogg has navigated through diverse market conditions, ranging from the 2020 stock market crash to the robust bullish rallies of 2021 and the bear market of 2022. And through these experiences, he has gained the importance of simplicity and adaptability in his stock trading strategy. Kellogg emphasizes a straightforward approach by stating that there's this acronym, KISS, K-I-S-S, which stands for Keep It Simple, Stupid. He goes on to say, I don't think people need super fancy indicators to make money trading. I'm just using basic trend lines, support lines, resistance lines, and volume, and those are my indicators. He goes on to caution against overcomplicating indicators as they can lead to trading based on indicators rather than the actual stock price action. So his more pragmatic mindset has enabled him to be a versatile trader based on his 4 indicators which we just mentioned, which again are the basic trend lines, supports, resistance, and volume. So very simple stuff here. This flexibility in his indicators proved crucial during the bear market of 2022, to where he was still making plenty of money, and Insider even obtained access to Kellogg's tax returns, revealing over $8 million worth of gains from day trading in 2020 and 2021. His trading income surged from $1.6 million in 2020 to an impressive $6.5 million in 2021. But Kellogg's journey started very humbly and simply, to where he started with just $7,500 for his initial deposit, and his success did not come without setbacks, and he did not become a success overnight. His initial attempts at trading resulted in major losses, prompting him to pause real trading and hone his skills through paper trading. And if you don't know, paper trading is when a trader doesn't use any real money, but he still uses actual stock price actions and volatility to see how he would have performed if he did use real money. Kellogg also had the financial support of his parents, and this allowed him to enroll into an online course about day trading from a renowned day trader who was a former penny stock trader, and this program equipped him with the skills and patience necessary for his future success. Now, I do want to insert a disclaimer. I myself am not a day trader. I am a long-term holder. I like to identify and buy fundamentally strong companies and hold them for the long term. The only time I will take profits off the table is when the company is overvalued at a certain point, where I will take profits, wait for it to drop below my average cost basis, and then rebuy the company. However, back to this amazing stock trading story. As Kellogg became a better trader day by day, he has capitalized on various upward trends in the overall market, and in 2022, amid a slower market, he continued to generate profits by strategically investing in popular stocks like Bed Bath & Beyond as well as AMC. A snapshot of his E-Trade brokerage account revealed a $60,000 gain from his AMC trade. Additionally, he traded small cap stocks, achieving substantial wins on single trades, such as Intelligent Living Application Group, which earned him over $91,000 according to his screenshot from his Guardian account. One of his primary tools that he uses to identify companies that are about to surge is the volume-weighted average price, also known as the VWAP, which is a nuanced metric that showcases the average price paid for shares adjusted for volume. Kellogg strategically utilizes the VWAP on daily charts to discern optimal buy-in prices for the stocks he trades, steering clear of the common pitfall known as chasing or FOMO, as some may call it, which is when you enter a position too late after the stock has already rallied substantially because you're just trying to keep up with the Joneses, or you're just trying to do what everyone else is doing, even though there's really not a lot of upside left into that particular trade. However, by maintaining a steadfast commitment to the timeless adage of buying low and selling high, Kellogg has avoided for the most part entering a position if the price surpassed the VWAP line. Conversely, when shorting a stock, meaning that he's betting on the share price decreasing and he can make money off of that, he refrains if the price is beneath the VWAP line. The VWAP not only guides Kellogg's entry points, but also plays a pivotal role in his exit strategy, to where he can recognize that certain points on the VWAP can signal potential reversals in a stock's trajectory. Therefore, Kellogg strategically uses this indicator to determine when to exit a position or cover his position for some profit. Kellogg further enriches his toolkit with the inclusion of linear regression, which is a multifaceted indicator that reveals the direction of price trends and potential trend changes. This metric, depicted by 3 lines overlaying candle charts, provides valuable insights into overbought and oversold conditions, which would tell an investor when to buy in or sell a company. If it's oversold, you would want to buy in, and if it's overbought, you would want to take profits. Kellogg emphasizes the importance of a stock respecting the lines of the channel created by linear regression, as this adherence enhances the predictability of the stock's price action according to the trading thesis. In short, Kellogg uses this indicator to determine whether or not it is a good buying opportunity to jump into a stock or if it's time to jump out of a stock. And he also pairs this with his other indicators. Another indicator that he uses is volume, which is a key indicator in Kellogg's repertoire, where this indicator serves as a potential harbinger of market reversals. By keenly observing significant volume spikes, especially those occurring near a day's high, Kellogg interprets them as indicators that a stock may be on the verge of a reversal, meaning that it's going to switch its trajectory. If it's going up, it's going to have a reversal down, and if it's headed down, it's going to have its reversal up. Kellogg's strategic use of volume provides him with a valuable tool to stay ahead of the market trend and identify potentially lucrative market opportunities. In addition to these technical indicators, Kellogg also monitors support and resistance lines, which are crucial markers in determining where a stock's trend is going to hold or sell off. For instance, acknowledging the dynamic nature of these levels throughout day trading, Kellogg employs a strategic approach to identify key levels, paying particular attention to parallel increases in volume in these areas. While he acknowledges that this is not an exact science, he places significance on areas where prices linger for 30 minutes to an hour, deeming them the strongest. Kellogg also elucidates a bouncing ball analogy to explain the potential trajectory of a stock. As the price hovers within a certain range, bouncing between various levels, it eventually reaches a critical point where it may break support and head lower, and or higher if it's a resistance level. This analytical approach showcases Kellogg's attention to detail in assessing the strength of support and resistance levels. Throughout his trading philosophy, Kellogg underscores the supremacy of price action. Even with a well-formed thesis, he emphasizes the necessity of adapting to the prevailing price movements. If the price deviates from the anticipated direction, Kellogg advocates for the importance of promptly cutting losses or covering short positions to mitigate risks and preserve capital, and this is literally the best thing you can do. If you are a day trader, having proper risk management is going to be the best way to not only cut your losses quickly and not lose any, but it's also going to help you with your overall gains. And even me as a long-term investor who does not day trade, having proper risk management will lead to better gains in the future. In the end, Kellogg's disciplined approach and his refusal to solely rely on indicators or overcomplicate indicators is a very good sign that this guy is doing day trading correctly. If an indicator fails to align with his trading thesis, he promptly cuts his losses. He adamantly asserts that he has never attributed losses to indicators, emphasizing the critical role of adapting to price action, meaning that indicators are not the be-all end-all. You have to use use your common sense as well to use these indicators as only guidelines for your underlying investment thesis, which is why it's important to always do your own due diligence on these stocks. In conclusion, Kellogg highlights that many day traders struggle with the psychological realm of trading despite having the best strategy and indicators available. Kellogg also asserts that the success of day traders hinges on the discipline and adherence to a well thought out strategy. He observes that mastering one's emotion is often neglected in stock trading, and he emphasizes the need for traders to invest effort in cultivating emotional resistance and resilience as well as discipline. In the intricate world of stock trading, this is a phenomenal success story with someone using very plain indicators. But let me make it very clear that this story is a success story and this is not the norm. The whole reason why this is impressive is because this is not the average stock trader story. The vast majority of stock traders lose money over the long term, and buy and hold investors normally make more money than stock traders over a long period of time, which is why I personally am a buy and hold investor and I don't want to have the risk of stock trading. But I'd love to hear your thoughts about this amazing success story. Don't forget to go and annihilate that like button for more videos just like this one. Subscribe if you are new. Go ahead and become a member for as little as 99 cents per month because that's what keeps me here on YouTube. And with all of that being said, I wish you the best of luck and happy investing.